povero cridere. You have taken my savings, my sleep, my soul. But hark! Through the darkness, two voices ring clear. Two men who speak plainly, two men who are here. No commissions, no secrets, no lies. Diversification, la verità. Talking real money.
Diversification, la verità. I can't do it. I don't know how AI does it.
Can I just say it then? Is it okay? The stock market's not going to crash until the fat guy sings. Is that right? Is that what this episode's about?
And he just, I thought that high note there near the end.
Paid a lot for that, apparently.
Yeah. I decided to throw some Italian in at the end. It's diversification is the truth, is what.
Oh, I thought I just ordered an extra tiramisu. Okay.
Diversification, la verità. Anyway, hey, welcome to Talking Real Money, the show that begins with the
European version,
the song of the day. And that was one I made a while ago, and I forgot to put it in an episode.
It's hard to imagine that since you've made so many of them that you'd forget one. But
I forgot one. And yesterday's show, I hope some of you went clear to the end, because we're now occasionally, not on every episode, but occasionally we're going to drop a musical Easter egg in for your drive to home or to work or your walk.
And please feel free to throw it at somebody. I will say to your credit, all the feedback, all of it still on the songs or the whatever you want to call them, the jingles, have been positive. So far, all positive. The people I've met.
I'm trying not to make AI slop. I really work hard on these.
Nobody denies that.
I play with the lyrics. I really do research, too. I like to find out about the music because I love learning stuff. I love to learn. Even at my...
Are you a lifelong learner, Don?
I am a lifelong learner.
Okay.
And I learn about a lot of music theory that I never knew because I never studied music theory. But it's some fascinating stuff about all the different
notes,
musical, not notes. The word is escaping me, and not keys. It's
my lifeline. I call my brother.
The different scales and things.
Okay.
So it's just fascinating. I find it all fascinating, and I get to pick instruments. I get to go. I want a dulcimer there. How many times do you get to request a dulcimer?
Not many. And somebody who came in the office the other day who was effusively praising your songs, but she also said, it sounds like Don has a lot of extra time on his hands. So,
well, I'm not writing a book anymore.
No, you're not.
Books take a lot of time. Now I'm writing music. Well, I'm not really writing it. I'm conducting. The best analogy is
next. I just wonder.
I'm conducting music. I'm not creating it. I'm conducting it. And today we're going to conduct you on a journey back in time. We're going to look back at markets that have done extremely well and then the inevitable declines that occur. And are we in such a situation right now? This is a question posed by the lovely and talented Jeff Summers at the New York Times. And, like all of us, we have to fill time. He has to fill pages with words. And sometimes we find it a little interesting or we want to take umbrage with it. So it's a little bit of both in this case.
Yeah, I think that's true. It's pretty. You forget some of the facts here that are actual facts. We're
going back in time now to the 1990s, right?
Well, first I'm going to do the last 3 years. If the S&P 500 gets double-digit gains this year, it'll be the first time in its history that it's had 4 straight years of double-digit gains. That's significant. No question.
That's as good as it's ever gotten, I guess.
Exactly. Only 3 times has it ever, since 1928, done 3 in a row. Now, the reason for the concern is the 1990s stretch when the S&P 500 rose more than 20% each year from 1995 through 1999 was followed by what? Well, a very unpleasant time.
Not just an unpleasant time, an unpleasant decade for U.S. stocks.
Including The S&P 500, which lost almost 57% of its value from 2007 to 2009. And more importantly, I think, because that's a pretty significant downturn, right? That's not to be.
Well, that was the biggest downturn ever.
Yeah, that's pretty bad. But I think more importantly than that is the fact that in the aughts, the 2000 through 2009, had you held the S&P 500, you lost about 1% a year.
Wait.
A year.
Maybe you ought to have held something different during that period.
You coy little. Anyway, yeah, you ought to have done that because guess what? A portfolio that included things like international small cap value, which made 11.2% during the period.
Wait, 11.2% over the 10 years or 11.2% per year?
A year. Emerging markets value, 13.8. International
Per
small
year.
cap. Per year, 8.6. Guess what? If you diversified into some of those other things, you ended up making 6.2% a year instead of losing for the decade.
Instead of losing 1% per year over a full 10 years. So there have literally been lost decades in individual countries' stock markets, including your favorite, ours.
Yeah.
That is a lesson that is oft forgotten. We had 10 years of awful market.
And it ought not to be forgotten.
It ought not have been that awful if you had opted to.
Well, so here's the thing that's interesting about all these numbers. Jeff can go out and find people like Capital Economics who say, we envisage the bubble inflating a bit more.
Did they actually say envisage?
Envisage. Pardon me. I threw an extra I in there. We envisage the bubble inflating a bit more during the rest of the year before bursting. Our year-end 2026 and end 2027 forecasts for the S&P 500 are 8,250 and 6,500.
Okay, they envisage. Couldn't they just say?
You take something to do that, or I don't know.
We guess. We're just spitballing it here.
I know.
Because that's all they're doing. We envisage. It almost sounds like they have a vision that we went down. We took some psychedelics and we had a vision.
That's what I'm saying. Do you have to take something to envisage? Yeah, so he and Jeff goes into talks a few other people who say, yeah, the end is coming. It's near. But he then also makes a very good point, which is a pretty good and I think balanced article. He looks at what if you're a market timer? What if you say, look, I'll just get out before the big downturn and then get back in?
Of course. That's what everybody wants because if I get out and then get back in later, I get to keep all the profits and I don't give any of them back.
Exactly. So he talks to Sam Stovall, somebody that we know.
Oh, I've talked to Sam many times,
1988 through 2025. Had you missed the 40 worst days, those really big days, you made about 18% a year. That's pretty doggone good, right?
Miss a few good days, you make a lot.
No, a few bad days.
I mean, a few bad days, you make a lot. Miss a few good days, you miss. Yeah, okay.
However, on the other side, the flip side, on the other hand, as the economists like to say, if you missed the 40 best days in that period, guess what your return was? You already read this piece, you know.
I don't remember. I think it was like 4%.
Closer to 5, but 4.8.
Something.
Yeah. So, I mean, this is the struggle, right? Knowing when to be in, when to be out, all of those things. And by the way, bonds did okay in that the aughts as well, making 3.4% a year. So he asks the question, and I will ask you, sir. He asked it right here in this paragraph. I see it right here.
I'm sitting here waiting.
Oh, you're waiting. I was waiting for the music. So what?
There's only going to be music at the beginning and the end. That's it.
That's very sad.
I'm not putting middle music anymore. It's too much work.
Please answer the question. So what is an investor to do, he says. What is an investor to do? So I put it to you, sir. I put it to you as the 38-year financial guru of the airways.
Oh, Lord.
What is an investor to do? What do we do here?
The same old, dull, boring
thing.
What
do we do? Come on, we gotta do something.
Diversificazione la varita.
Is that real Italian? I didn't know. Okay.
Yeah, it is really Italian.
Wow, good for you.
Diversify and be patient. Yeah. That's it. There you
That's
go.
it? No, that's not
We
quite
went
it.
through all
I have
that
a few
trouble
more.
just for
I have a few
that.
more. I have a
There's
few
more?
No, there's more.
No, don't make it more
You know what?
complicated than it needs
Well,
to
no,
be.
it's not more complicated, but it's more simple. Because
How
all
much
of
more
this-
simple can you be than own the whole thing and sit still?
Well, before you own the whole thing and sit still, you have a
No, it's the plan.
Yeah,
gonna
the
give you-
plan,
No,
because-
Tom, you turn people off instantly when you say you must plan.
they hate me for
There
it.
are those of us who love spontaneity. We don't like the plan.
This is a guy who just took 14 people, moved them from Lake Chelan to Southern California
You are
overnight.
never
so-
going to let us
No,
forget your
I
one
don't-
moment of spontaneity in your entire life.
Anyway.
moved the whole family from Lake Chelan, where we were going to die of smoke inhalation, to Los Angeles County.
We just talked to somebody
Or
who stayed
Ventura.
that
What
whole
county
week.
were you in? What,
They stayed the entire time.
at Chelan?
Yeah. They were inside playing board games. And okay.
You know, the
a
smoke
great
still
family.
gets in.
Maybe it got into them a couple of years ago. Anyway, having a plan, because then you know before you invest any dollars how much you need to make. Just had this discussion with somebody yesterday. Rather than just saying, I'll just be exposed to stocks. That makes no sense to me. None. It never has. You've got to know that. Number two, you need to understand your emotions. This is why we have the risk quiz. Because you know, if you find out that you can't handle the heat of a 60%
can't
downcrease,
handle the heat.
exactly, then you shouldn't be all in stocks, because that could happen again. And you mentioned the one. I think this is the problem in the bigger picture for most investors is thinking long term and staying disciplined. Just talked to our clients about this the other day, that it's hard. Investing is hard in that way because you have to just, as you said, sit there and take it. It's not easy.
Because we're battling against our crazy psyches. I mean, where do you think the term psychosis came from? It's our crazy psyches. A lot of us don't control our emotions very well,
and
particularly when it comes to things like money.
Well, and there's a lot of messaging. There's a lot of push. There's a lot of people yelling at you that this is bad, it's going to get worse, and you need to do something. That creates a lot of bad behaviors. So I'm not going to put it all on everybody
the bottom
else.
line, though, really, the bottom line, we always say plan, but I know you're not going to do that. But the trick is whatever your allocation between stocks and bonds for your risk profile, just diversify. Don't get hung up on any one market or asset class or even two or three. You just own them all and quit worrying about it. That's the theme of many of my theme songs for the show.
And they're good. They're uplifting, even though I don't understand half of them.
And
I really
by the
like
way,
heavy
just
metal
want to let you know, I know you had some requests for heavy metal.
Yes.
We
You
do
got
have
one done. I heard
we have a heavy metal theme coming up
I know. It's really good.
for all of you heavy metal fans.
AC/DC hits
It's
TRM.
it's sort of. And I discovered I'm not a big heavy metal fan. I discovered that there are multiple varieties of heavy metal in my research. There's the Euro metal thing, and then there's sort of the British heavy metal. Then the American. There's just various versions of it. Who knew? Who knew? Well, we know that you need somebody to talk with. We know that. That's why we're here, and that's why we love answering questions. I don't
We
want
love asking them, too.
We
by
can
the
ask
way.
them too. We like it when you ask him, and Tom loves it when you give him one that requires him to pick up the phone. You just go to talkingrealmoney.com and click Ask a Question, and you give him one of those questions that just kind of gets him going, and he'll pick up the phone and call you.
From Davenport, Florida, Jim joins us here on Talking Real Money. How you doing, Jim?
Oh, doing pretty good, Tom. Thanks for listening to me today.
Absolutely my pleasure. I'm glad to know, I think, looking at my map, Davenport's not that far from the Sainted Celebration, Florida. So you're closer to Don than probably I will be in the next 5 years. So I guess I don't know what to warn you, or I don't know how that goes. But either way, you should be aware of it. Let's just put it that way. So
That's for sure.
what can we help you with?
Well, so kind of, my wife and I are looking to retire here within the year, and we basically have about $1 million portfolio, and I'm curious to know your feelings for it. We used to have the we still do, Schwab Intelligent Portfolio, and we had access to a financial advisor that kind of took that away. You might have read about that. And so as we're getting closer to really needing a good withdrawal strategy and tax planning and all that neat stuff, it was time to start interviewing a couple folks, the financial advisors, and get a feel of what's out there. And I was a little taken aback by the first one that we talked to, because they suggested in the portfolio, knowing that we were, retiring within the year, of owning, in this case, 30% put into individual stocks. Now, I'll just reel off some of these to let you know that these are like blue chip stocks. They're Google, Nvidia, Meta, Apple, Broadcom, Chevron, Verizon, JP Morgan, Honeywell, Merck, Johnson Johnson, Microsoft, etc. So there's like 20 of them. And I was wondering, first of all, that just seemed really high, knowing that we're going to be retiring shortly. What is your feeling, your company's feeling too, towards having, first of all, just owning individual stocks? I've never done that before. It's always been mutual funds or nowadays it's ETFs. And also doing so close to retirement and, getting the withdrawal strategy going.
Yeah, there's a couple of things here that are worth considering. I mean, sure, a fiduciary advisor can use individual stocks. Their licensing, their fiduciary status does not eliminate that as an investment choice. And my question to them would be, why? Because people only use individual stocks for one reason, and that is they believe those stocks will make more than the broad market. Most fiduciaries use the funds you mentioned, broad index funds, or, if you have to call them actively managed, they're, rules-based, index-like, whatever it is. They're widely diversified. So very few fiduciary advisors would use that style. So I'd have to know why. And I mean, and I personally wouldn't do it because I can't find anybody who can pick stocks. And we just did a recent podcast where I think it was 13% of the large cap funds over the last decade have done better than just owning the index. So that means you have to pick the right, 5 or 6 stocks for the next decade. And I don't know anybody who knows, is Nvidia going to be better than Home Depot? I don't know, and I don't think they know. So I'd have to understand why they would do that. But then back to your other contention about your sort of near retirement. The near retirement part would really come down to how much in stocks and how much in bonds, and therefore how much I can afford to take out. That would be something that a good firm, the first thing they would do is write that plan to tell you, here's how much risk we feel you need to take for the next 30 years so your money survives. Taking that risk would be in stocks. Any advisor that's worth their weight is going to have a hard time defending a individual stock portfolio, because it's like, have you done that? Have you been good stock pickers? Why am I in, Nvidia instead of Meta? Or what? I mean, I don't, to what end do you know what the future is going to look like to put me in those stocks? So yeah, there are not very many people that do that. There's some. It kind of harkens back to the old days of a broker dealer. When I look at portfolios from a Merrill Lynch, for example, they generally have a few little index funds, because they can say, yeah, you're in index funds. And then they have a few actively managed funds. And then they have a smattering, I think you said something about 30% of individual stocks, because the back room has told them, well, these are really the winners. We want to be in the big, we want to overweight to those because they're going to make more. So, but that gets all of this gets back to a decision you need to make, Jim, about what you believe as an investor. We know what we believe. We've believed it for, 35 whatever years. That is, be broadly diversified, keep your costs low, and be as tax efficient as you possibly can. That's counter to any advisor that's going to say, well, yeah, kinda, but I think Home Depot is going to be better. I don't know that, and I don't think they know that. So I would rule them out based on that. And oh, by the way, you asked about our firm. Our firm ascribes to the aforementioned strategy. It's wide diversification, U.S., international, big stocks, small stocks, growth, value, all those things. The right plan to support that and then keeping your costs as low as you can and being as tax efficient. So I don't play in those waters. I know those waters because I used to have a TV show where I studied all these companies, read about them. I could never find anybody who could tell me anything more about what they were going to do in the next day, year, or 10 years. So that's why I haven't done it. And I wouldn't trust a firm that told me that because I don't know what they would base that on, I guess.
I kind of just wondered because both of the ones that I interviewed, they're pretty young guys, and in the past 10 years, the market really it's only gone up, and for the most part. I was wondering if maybe age had something to do with it.
It very well may. Yeah, I mean, your confidence, you may be overconfident thinking, well, yeah, we had the little hiccup in, 2020, but it came right back. We had the down year in 2022, but it came right back. So if you haven't really faced a bear market, but bigger than that would still be, you have to be pretty arrogant, I think, to believe that you can pick stocks because the track record now is so poor from the best and the smartest people, the people that spend billions of dollars on this and hire the PhDs and, study the satellite photos to tell you how many people are shopping me at Walmart, all those things. And they can't tell you what the best companies are going to be, including the greatest stock picker of all time. That would be a guy named Warren Buffett, who also tells you, yeah, I had my day, but just buy an index fund.
Well, you have confirmed my belief. So I was just very apprehensive about that first one. The second one was much less percentage-wise and more than willing to just not do that and just kind of get it out of a single stock type portfolio. So
yeah, no, and I would really anybody who proposes that, I'd really scrutinize them as to what their investing philosophy is, because again, if your philosophy is diversification, if your philosophy is keeping your costs low, and your philosophy is, accepting market-like returns, then you're just not buying individual stocks.
All right. I appreciate your time on that. That's it's confirmed my feelings, and I'm going to move forward with that knowledge.
Good. I appreciate it. Please drop by. I know you're close by. Drop by and knock on Don's door. Make sure he gets out of his room at some point.
Hey, if you could ask Don a question for me.
Yeah, go right ahead.
We like to go up there every once in a while. It's only 5 miles, and do some shopping in restaurants. He's a big cheese up there, right? He's basically the mayor of the city, I think, or something. So he just wants some restaurant recommendations. I mean, we for Celebration Town Tavern, but if there's any others out there, please let us know.
I will get that. We will include that on an upcoming podcast. Restaurant recommendation for Celebration. Jim, you can count on it.
I appreciate it so much, Don. Thanks for letting me send your ear.
Indeed. Really appreciate you listening, and we'll talk again soon, I hope.
Okay.
Thanks, Jim. You take care. Bye-bye.
Why wait for another podcast when I can do it right here on this one? Davenport's just down the road. And by the way, I keep telling Tom this, but it's not a city. It's not a city. It's just it's a community. It's a census designated place. And I'm just the president of the HOA. Somebody had to do it. Places to eat in Celebration. Town Tavern is the place that people always go. I think Columbia is amazing. Columbia is a chain of a few restaurants that started in Tampa or Ybor City in 1905. It's Cuban, kind of a Spanish food. Very, very good place. And my new favorite hangout place is at a new shopping center in Celebration, and it's called Celebration Brewing Company. And I love the Celebration Brewing Company. They are terrific. Otherwise, in his never-ending quest to kill all the trees in the Pacific Northwest, he will print out your question, place it on a piece of paper. Remember how we used to do that back in the old days? We used to put things on paper. And then he will hold it between his fingers, glance down at it through his old man reading glasses like mine, and speak the words on the page in the form of a question.
Yeah, this one comes from Patti LaBelle, Florida. Justin. Who knew she got that big anyway, by the way? That's kind of surprising me. Hi, Tom and Don, in support of Tom's War on Trees. Thank you for that, Justin. I love your show and consistency.
Okay, if he's from Florida, it's like the Northwest. You can be anti-trees because they grow faster than you can cut them down.
Yeah.
But poor folks on top of a mountain in the Rockies, those trees take 1,000 years to grow like an inch.
Or I was just in Rome. I think they have a total of 3 trees. They might want to plant a few more. I love your show and consistency. Thank you for all you do for everyone. That's very kind of you. You always talk about global diversification with stocks. We just did that, by the way. Why not the same with bonds? If I don't mind the work, how much of an ETF like BNDX could be paired with U.S. bonds like BND or a CD ladder? How much in international bonds is too much, and what ETFs or funds besides BNDX would you also consider? Is adding municipal bonds to your brokerage account for diversification, not just for taxes, a good idea? What say you, sir, when it comes to international bonds?
I think it depends on where you are in your financial journey. If you're near the beginning of it and you're just using bonds to reduce the volatility a bit, why bother? Why bother? One of the things, the biggest reason we want bonds in our portfolio is for stability, and you add a second helping of potential instability, volatility, through currency exchange rates. You see, if you own BND, it's denominated in dollars, so it will never be worth fewer dollars. It's always worth dollars. You don't have to turn it from euro into dollars at a higher or lower rate in the future. It's not. They can make your portfolio more diversified, but they also are a riskier proposition. They are riskier in a variety of ways, and that is not what we want to add to our portfolio, generally speaking. I don't find them necessary in almost any instance. I mean, maybe you could add them when you're at those big 20 fund portfolios we've talked about.
Getting to that later, yes. Yeah. Okay. So, in our bond portfolios, if you have significant bond holdings, we do have some international bonds. Diversification. Mm-hmm. That's about it. So it
reduces I guess it hedges your U.S. risk, your dollar risk.
Yeah.
But again, early on, why bother? I'm a big fan of really keeping it simple. A stock fund that's really, really well diversified, like an AVGE or a DFAW, and a bond fund like BND or a CD ladder that you run on your own, or a short term, or an intermediate term treasury bond fund of some sort, ETF. I think you're fine.
Yep. From Denver, Colorado, Lawrence writes, on a recent Friday Q&A, Tom indicated that an advisor might have 21
funds. See, that's not you.
funds.
That's me.
I know.
Friday Q&A, that's me.
I know. Tom indicated that an advisor might have 21 funds in a portfolio only to suggest that they are valuable. This came up in another program.
Yeah.
And I said, sometimes I see portfolios with a lot of overlap because the advisor can say, look, I picked, X, to make themselves look more important. You could never figure out how to manage 25 funds.
It's hard. It would be very hard to do.
It would be hard.
That's a ponderous rebalancing process.
Yeah. I found this very surprising because a while back I did an excellent review with Appella, which had no hard sell, by the way. And I was shown a portfolio.
He said that, not you.
He said that. And I was shown a portfolio that Appella might suggest for me, given my risk tolerance and other factors. I thought the suggested portfolio made a lot of sense. It didn't have 21 funds, but it did have 20. Mm-hmm. Can you speak to this apparent conflict?
That's not a conflict. It's for you as an individual. That's too many funds. I do think, and okay, I am a little cynical. I do think that we may go to that many funds again because it makes us appear more valuable. Maybe. I don't know. I don't know the reasoning. I mean, there's an academic reason for every one of them that can be made. Every one of them, there's a slight potential benefit to them. But the reality is, who cares? You've got somebody else managing it for you.
Well, that's part one. And I was going to say that. But part two is, yes, frankly, the people that manage them, we have an entire team, I don't know how many people it is, that look at these things every day, manage it every day, and are looking at the funds and all the things you could invest in. That's more work than you should be doing at home, frankly.
All they do is study the studiers who are studying the studies.
Looking at him who's looking at me.
Yeah.
The fact is that they have, because of the research, uncovered, not us, but others, and now we use them, things like momentum, things like profitability, that I don't think you at home should be trying to buy particular funds for. I'll put it that way.
Okay. Yeah, that is a great point. Let me take you back in time a little bit. When Tom and I first started in this evidence-based...
Do you know how many years it's been now?
30?
No, well, okay, in this particular outfit, 17.
Okay, but I mean going back to Merriman.
17. Going back to Merriman would be 1998, I think.
Yeah. So
I
a
can't
long
do that
time.
math. Almost
a long
30
time.
years.
It's about
Yeah.
30 years.
Yeah, close.
But back then, I remember the early days of the Fama and French research.
Yep.
And it was really pretty much three. Stocks, equities were a factor because they...
Exposing yourself to
yourself to
stocks.
equities was one. Then overexposing yourself to value and to small
come up
companies.
with another term, overexposure.
Yeah, overexposure. That was it. Those were the factors.
Yeah.
And then they said there could be other factors. We just haven't seen them yet.
Yep.
And others kept doing research, including Fama and French, but many others, because there are a lot of academics out there. And they found, and this was when we first read the paper on this, and I remember this really clearly.
You were in the office, actually.
Yeah, we read this paper. As a matter of fact, I think I brought it to you guys.
You may have.
I brought it in for the podcast, and I went, okay,
What?
have you guys seen this? And it was profitability.
Yep.
More profitable companies are likely to make more money. I called it the duh factor.
Yeah.
Duh.
And it holds.
And then there was momentum, and then I don't know, but these
Quality.
factors have been discovered, and when they are discovered and well vetted, then because we have advisors managing your portfolio for you, making sure it's done properly, we can add those factors to your portfolio, potentially increasing your returns. And it's only fractions of a percent.
That's right.
But a fraction of a percent here and a fraction of a percent there, and pretty soon you're, what? Oh, talking real money.
Yeah, and by the way, go back and look at some of those fractions the last couple of years, because things like momentum, they've been big drivers in the market the last 2 years.
So
don't know
that's
when,
why.
but
That's why it's hard for you to do. We will never on this show ever suggest to individuals a 20-fund portfolio. Ever.
No, because it'd be hard to do. We got time for one more?
Yeah.
Alyssa Viejo, California. Kelly. A few years ago, my husband and I went to a fee-only advisor who created a financial plan for us. We followed his plan to create a diversified portfolio. We planned to rebalance the portfolio annually, but for the first couple of years, our percentages were so close to their targets that we didn't need to rebalance. This year was different, so I sat down thinking, this will be simple. Don and Tom say just sell the winners and buy more of the losers.
Yeah.
Yeah, we do say that.
It's simple on paper.
Yeah, pretty straightforward, except that all the winners are in our Roth IRAs. Because also, and I'm adding this myself, we do suggest asset location as best as you can do. In other words, the riskier thing should be in Roths because you hope
as
for
best
faster growth.
as you can do. There's
That's
the qualifier.
thing. Yeah, I know. So, because when people come in all the time with bonds in their Roths, and they could have them in their traditional, I say that should be in the traditional Roth.
Yeah, but how do you get it there?
Yeah, well, you have to sell one and buy another. But that's the thing.
No. But how do you get it from the Roth into? You can't take it out of the Roth.
No. You sell something in the Roth and then you buy something in the traditional to make to build it. Okay. I don't understand what you're saying. So anyway,
no. What I'm saying is,
they
could not. You don't liquidate your Roth to move it into your brokerage account.
No. I was saying IRA. I was saying own those. Yeah, anyway,
okay.
We're good. But here's the question. We want to move funds out. We don't want to move funds out of the Roth, what you just said. The losers in the portfolio where the percentages are aiming for under what the plan suggests all are things like bonds and money markets. So, yes, you would expect stocks to go up faster than money markets and bonds, and they have. We don't want those in our Roths. We're both 60 and looking to retire at 65. The question is, I guess, at hand here, how do you rebalance if, yes, all the one type of things are in one portfolio like Roth, and all the other things are in traditional or brokerage?
Then to avoid getting overweighted in equities, which is what you are right now, I'm sure that's because they've done very well, you have to sell some of the equities in the Roth and buy a bond ETF in the Roth.
Yeah, you're going to have to. It's the asset location's not going to be as pure as we would like it. But you're right. To hold to the correct stock to bond ratio, that's what you're going to have to do.
And to me, that is more important than having a lot of stocks in the Roth. The right ratio is going to save you psychologically in the next downturn, whenever it happens and however bad it might be. You've got to continue to have that. Or you, what will happen is you'll get overweighted in stocks because they outgrow bonds always over time. They always have. And then when there's a big downturn, it's going to hurt a lot more. There you go. We've reached the end of another episode.
Oh, so exciting.
Thanks for being a part of it. Tell your friends, tell your neighbors, tell your enemies. Hey, help them out. Come on, it could patch the relationship. And
Might not too, by the way.
and or not. And maybe they'll be so miserable you'll feel better about recommending us. Maybe they'll hate us. Maybe they'll be those people who just hate us. Tell all your crypto enemies about us so they can hate us. And then send in your questions at talkingrealmoney.com. Speak them with the little button. By the way, the little button in the corner, the speak the questions, I neglected to mention this. There is a 2-minute limit.
Really?
So be
had
concise.
I had that in my first marriage, I'd probably still be married.
Probably.
2-minute
but you
limit.
didn't.
But
Yeah,
I
hindsight
should
is
have done that.
20/20.
That's a really good idea. That's smart.
And then, and as people keep saying, if you want to sit down with somebody and get a little bit more help, I know of one place,
No, kidding.
2-minute limit. I know of one place you could do that, and that's it with our firm Appella. We will let you spend some time with one of our advisors for free for nothing, and there is truly no high-pressure sales pitch. Really. Honest. You just get info. And for that, click Meet an Advisor on our website. Oh, and by the way, now, all of the themes that have been played, all the musical themes that have been played are now in a section at Talking Real Money. Look in the right-hand column. It says, what would you like to do? And you could say, listen to the show music. There's a whole playlist of all the show music. If you love it so much, you can't get enough. And I'm going to start dropping in there some of my 4- and 5-minute complete songs that are themed to different things. Like I'm working on, it's almost done with the free steak dinner one. It's called That Steak's Not Free.
In what style? What genre?
It's all of these are going to be, because they're my album that I'm doing, the Talking Real Money album. So the Talking Real Money music album, and it's all in the genre of sort of modern cinematic art rock.
Art rock.
Art
That's
rock.
an expression I've maybe never heard, so I'll look forward to that.
So
do they play back to back to back, or do you have to play them each individually?
They play back to back to back to back to back.
So you can just sit there at your desk and listen to...
I SoundClouded them.
I don't know.
You don't even know what SoundCloud is, do you?
No, I don't.
Yeah. SoundCloud is a place where
Clouds don't make
musicians
any
can
noise.
put their music for free if it's less than 2 hours.
You're just waiting for the Grammys, so we'll see what happens.
No, because again, the U.S. Copyright Office has basically said these are not copyrightable.
So somebody could just steal
Even
your
though
idea?
I was the conductor and I created the lyrics and I came up with the idea, it doesn't matter. The Copyright Office says if it was written by a machine, it's not copyrightable. I don't care.
I feel bad for you.
I truly don't care. So what do I care if somebody uses one of them? They're not making me any money. But we hope we're making you money as we sit around here on this Little Here podcast.
Talking real money.
The opinions and views expressed in this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions.
Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy.
Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor.
Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services.
Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. I think I need a nap.